Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Chokalingam of Economics Research and Advisory and Vineeta Sharma of Narnolia Financial Advisors join me on the show. Thank you to both of my guests for joining me on the show. Today on Hot Money, we'll discuss the alcohol space. We decide which is a better pick between United Spirits and United Breweries. What's the view there? CG Power is something that has been buzzing of late, but we're asking, should CG Power be accumulated at these levels? We ask our guest to name one stock which actually has a high return potential, but is also a high risk stock that is there. And we talk about the insurance space, which actually is seeing a lot of traction, which is the best pick among the insurance space. But we are in the final week where New Year will happen, so a lot of alcohol stocks pretty much will be in focus. So we'll discuss the liquor space in details, and we'll discuss the two large stocks, United Spirits and United Breweries. So we ask, I guess, if you had to pick one, which would be a better choice and why? So that's the first stock that we want to talk about. So Mr. Chokalingam, what's your view on both these stocks, United Spirits and United Breweries? Would you accumulate either or neither?
Neither. I mean, okay. I would not buy, because if you see both of them trading at 51 to 64 PE, and this is not the right time because you have a general election in May. Now, and if you look at the state finances, 20 to 25% of the money is coming from the liquor sales, the duties from the liquor. And now most of the state governments are competing with each other, are within the state competing with other major party, to waive off farm loan, to announce a lot more welfare schemes. This would mean a lot more pressure on the state finances, and even for the center, there would be a lot of pressure because the non-tax revenues are going down. So therefore, net to net, by general election time, we can expect more tax hike on the liquor to finance the fiscal stress.
So are you saying only these two stocks, or are you negative on the entire liquor?
Entire liquor, because see, you have also, this is a little sort of cyclical based on the input prices. Now you look, the same stocks were available cheaper. Now if you look at, for instance, United Breweries, 64 PE. So this is not the right time to buy at such a fancy valuation when things are going to be a little tough on the tax front. That's my argument. But still, if you say between these two, then I would choose United Breweries Limited. There is a scope for MNC to increase the stake, and its profit stream is more consistent than the United Spirits. So therefore, if I am forced to choose, I would choose United.
Company specific, apart from the valuations, are you seeing any risks as such as to the business model or something on either of the companies?
Certainly, as a student of economics, I can tell you confidently that it's going to be a tough time. Because the middle class is already crying that too much of tax on them. On the other hand, on GST also, the government is moving towards reducing the tax. On the other hand, the telecom revenues have dried down, and the PSUs, whatever can be done in terms of disinvestment, special dividend, that's also happened. Cash got depleted for the PSUs. So central government is also going through problem. State finance also going through problem, in the sense there's too much of welfare schemes announced. You look at all the states which went for election, they're competing with each other to announce a lot more welfare schemes. So all this would mean definitely more and more sin tax on these liquor business.
Okay.
So if they are cheap, one can take a chance. But the valuation wise also, they're not cheap.
All of them are. Yeah, you don't like a single stock in the liquor space?
Certainly not.
Okay, what about you, Vineeta? Anything apart from the two of them, do you like anything? Are you recommending any of these stocks to your clients?
So if we compare United Breweries and United Spirit, we're liking United Breweries. And if we look at the financials of United Breweries, they are far more consistent. Their volatility in the profits or even in the return ratios is not there as compared to United Spirits. And this year in FY19, they'll be achieving a highest return on equity of around 16%, which they have never had in the history. And considering that, if we look at, these stocks are always trading at high valuation. So that's the point, like at this particular time, if we see the valuations of United Breweries, they are around some more than 3-year, 4-year average, I mean lower than 3 to 4 year average. So I think, and if we consider, definitely the top line growth has come on the back of last year's highway ban, which, there was a low base, so the top line was much ahead. But if we look at the internals, there was a realization increase, so higher premium premium brands were getting sold more. That has given far, like our estimate that has surpassed our estimates of gross margin, EBITDA margin, even PAT margin for that matter. So I think the whole structure of United Breweries, considering the top line, they've come out with a new product also, which is not alcohol based, and they have launched in Gujarat and places. They have gained market share. So I think United Breweries is a good stock. It's trading in around 3-year lower average historic valuation. So I think if somebody has to compare, they can go with United.
Anything
Breweries.
in the alcohol liquor space that you're recommending to clients at this point of time, apart from United Breweries you spoke about?
So we are not pushing United Breweries. Just if we compare the two and somebody has got interested.
What's your concern with United Spirits? Do you have any concerns? Or?
So as such, we do not have concerns. Similarly, if you look at the financials, both of them are turning around at the same way, just the way United Breweries. But if you look at the return ratios of, so our strategy is to get into a company which is giving healthy return on equity 2 years hence if you're looking. So considering the net worth and the debt in the United Spirits books, and there are going to be sales of some non-core assets, so there is a little bit uncertainty as to how things will pan out. And in case of United Breweries, things are clear. So it's a very low or no debt as such which is to be concerned, and growth is also fairly good.
So out of the two, United Breweries would be a better pick. So that's, I believe we got a viewer query also who was asking ahead of which is a better stock to buy. We discussed that, and I think both of our guests, Chokalingam doesn't like either, but if you had to choose, and what Vineeta also said, United Breweries is a better pick than United Spirits is something I hope the answer helped our viewer who put in that question. So that was the first one. Again, the second stock we want to discuss is CG Power. Now, basically, it's one stock which has, it's done well off over the past few days, but it's been a relatively big underperformer. It's actually lost 50% of its wealth in the last 12 months. So it's doing a lot. It's selling a lot of its assets. It sold their profitable, a couple of years ago, they sold their profitable consumer business. So they're left with all the power business, the industrial business. But would you venture a bet at 43 rupees? Is it still worth taking any kind of bets on a company like CG Power? What do you think? Should it's corrected significantly, now it's left with, and it's trying to do a lot in selling a lot of their issues. They sold some of their Hungary units and all. Should someone take a bet on CG Power, or is it an avoid for you?
See, CG Power, it's first of all, it is not there in our active coverage. And secondly, so whatever business we can make out, like it's been 4-5 years, and there has been a cash outflow of around 1400 crore if we total, and the debt part, the company is not able to manage that way. 6,000 crore plus top line, and that is not contributing to the bottom line. So 3-4 years is a good amount of time. They are trying, and recently also we've heard a lot as to what the company has been initiating. And but then that's not actually happening. So losses, debt from the discontinued business is still 600 crore, and the company's debt is around 2200 crore. And overall, if we see this segment, is that what we are liking. So in this segment, if somebody in the industrial space, so we're liking Cummins India much better. Okay. So financials are pretty much in shape, and even guidance for the management going ahead is pretty comfortable. They have raised the guidance. They have launched some new products. There are a good amount of good amount of ramp up in case of marine business as well as the railway segment. So I think Cummins India would have been a better choice if somebody wants to take a bet on the industrial segment, because we are expecting some private capexes kind of boosting up, and we have seen some signs the kind of management guidance has come from Cummins or Siemens. So we can smell something good cooking at the private.
I mean, one of our viewers, my producer, just asked me, they said, does it make sense to buy ABB India rather than CG Power?
CG Power, so we are not recommending. It's an avoid from our side unless until we get something on the view. ABB also, I'm not having a very clear idea, because valuations are not pretty much in favor. So we're liking Cummins India. Cummins India is one where we are seeing good amount of traction in the sales growth, new products, and as well as on the export front, they've had margin gains. But then that will be offset by in the current scenario. But still, the management is in a position to take price hikes, which was not earlier. So things are improving out there. So somebody has to bet on. We are liking Cummins.
Okay, what about you, Mr. Chokalingam? Has CG Powell totally lost the plot because something doesn't add up, because they're trying to do a lot to do a lot, and it's not like they haven't done it. They've sold a lot of their businesses, but somehow it just doesn't add up.
Yeah. As you rightly said, they have helped the shareholder by demerging and creating, some value through CG Consumer. But certainly, I will not touch CG Power. If it moves up beyond 50, I would suggest a strong sell. Because if you look at the consolidated versus standalone, there are so many subsidiaries. Collectively, they are not making money; they are losing.
Yes.
And if you look at the standalone balance sheet, it gives you a lot of worries. They have 1,028 crore of non-current investments, basically into subsidiaries. As I said, they are not making money. And then they have if you look at the September results, they have the loan of almost 2,324 crore. Really surprising. I mean, the loan given. And then the inventory and receivables another close to 2,000 crore. So if three items, if you include the investment in subsidiary which is not making good profit, and receivable and in inventories, and then the loan lent, they alone account for 70% of the balance sheet size.
Yes.
And the stock is trading at 21 PE. So why should I buy this kind of stock at 21 PE in this market where nearly 1,000 stocks have fallen over 50%, and including some of the great value stocks also crashed. So I would buy some good quality value stock.
Like?
There are many. I mean, just to name, like for example, Karnataka Bank or Balmalari Company.
No, anything in the capital goods space that
I buy Siemens, which is not cheap. So I was referring to the value stocks.
Yeah.
So instead of buying this, I would buy a value stock which are available in single digit PE or 5%, 6% dividend yield. But in this space, if you ask me, I would prefer Siemens. Balance sheet is strong, and I expect some special dividend also by selling off one of the divisions. Already there are a lot of cash. So definitely there will be a good news from the company.
So even if someone is looking to buy for a slightly longer term perspective, they should avoid CG Power totally.
Definitely, because unless the balance sheet quality is improved, I will not touch this kind of stock, because we have seen particularly last 2-3 years the companies which had a huge balance sheet stress, the risk was phenomenal. A lot of people have lost a lot of wealth in the market. So I would not take any chance by investing in this kind of company when you are 70% of the money is going into loans, receivable, inventory, and investments where you are not making any good return.
Okay, so that's the view that's coming in on CG Power. It's a clear avoid as per both of our guests. So that's the view on the second stock. The third stock is something that we're giving our guests the freedom to talk about. A lot of stocks have actually come down significantly. Now you're trading in the stock market, and that's not risk-free. But there are certain stocks which have fallen much beyond what the regular stocks have fallen. So are there any stocks which have fallen significantly, which offers a high potential of outperforming the market at this point of time, but remember at the same time also has a high risk return on that? So Mr. Chokalingam, any stocks that you believe can be a high risk, high return portfolio for someone just to park some money?
Yes Bank.
Okay.
Which is down 58%. 5 years back, exactly the same thing happened.
Yes.
There was a lot of negative perception on the market. Stock went down from above 500 to around 220. Same stock went up to 800 level in the next following 3-4 years. Of course, I am not projecting that kind of multi-bagger opportunity now, but my target is around 300 rupees. I firmly believe that it is easy to achieve that. The risk is, only if RBI finds something or the auditors find something wrong, that is the only risk. One should not worry too much about the noise created in the market. On the positive side, we have seen, even stocks like a Treehouse, Wakarangi, lot of noise in the market and people destroyed. So one should not worry too much unless RBI itself gives some alert or warning on the bank. And after all these episodes in the banking industry, I have a lot of faith in the RBI that they will not allow any miserable thing to happen in a private bank. They must be, doing all due diligence and auditing. And also, if you look at the company's balance sheet, the adjusted price to adjusted book value is only 1.7, and net NPA percentage is less than 1%. Even if there is a further slippage, even if net NPA becomes 1% to 3%, I'm still comfortable because even Axis Bank, ICICI Bank have net NPA percentage of over 3%, and commanding around 2 or more than 2 times price to book value. And also, when there is a stress, unlike PSU banks, there are many PSU banks that have stress and their business is also degrowing. Whereas in Yes Bank, yes, there is a stress in terms of the perception, but the business is still growing at 50%. That itself gives me a lot of confidence. So therefore, I would buy. In fact, most of our clients also bought Yes Bank. We continue to advise them to buy.
My thing is, do you believe that such a big fall was warranted only on the news of Rana Kapoor not being able to be in the helm of Yes Bank? Was such a big fall warranted or it was unwarranted?
It was unwarranted. As I said, I would panic only if auditor finds something wrong or RBI finds something wrong. But this was unwarranted. And we have seen, forget Yes Bank. About a year ago, we saw Infosys. What happened to Infosys? It came down below 850 rupees. So many institutions have downgraded, put on hold. Even for Infosys, it could happen. And the same Infosys, later it went up by 80%. And then you saw all who had given downgrade giving upgrade. So today, according to me, the fundamental research has a scope only for 30%. 70% it has become a game of perception. So it's more a behavioral aspect than research, because every analyst on the street has access to research database. So it's going to reward people who bet on removing the bad noise and going by valuation and fundamentals and sticking to the confidence level. They are the only one who are going to make money. It's going to be very tough in the future otherwise.
Okay, that's the view. So Yes Bank is something, and on the financials you are happy. You didn't find, see, when there are issues there, but when you studied the financials of Yes Bank, is there anything that's of a concern to you for Yes Bank, or you are absolutely fine with it?
Not at all. Look at the pledging. I mean, today, 1 out of 3 or 2 out of 4 have pledged the shares, promoters. So what is wrong if a share is pledged by the promoter? And 2, look at the family person starting a competitive business. Now, if Mr. Rana Kapoor has only 9% stake, and if I divide among all his family members, each person will get only 2% stake in a bank. And if I have only 2% stake in a bank, what is wrong in my family member starting a competitive business? It is not like a manufacturing company where they can have up to 70% stake. So what is wrong if I am not allowed to have 75% or 50%? For a family member, my stake is only 2.5%. So what is wrong in starting a competitive business? So you look at all the market fear, point by point. I have analyzed it. I have no doubt. I may be wrong in case the book is the NPA is suppressed, but I have faith in the regulator. I don't think after such a big noise, the regulator will be silent if there is any suppressed element in terms of NPA.
Okay, so the Yes Bank is the first stock that Mr. Chokaling likes. Before I ask you your stock, do you have a view on Yes Bank? Are you all recommending? Do you all have it under coverage? Are you all recommending it to clients?
So we had it in our coverage, and we are still, not giving any ratings. Since last 2 years, we have not pushed Yes Bank, considering it was somehow, a chance that we were not recommending Yes Bank because we had Axis Bank, ICICI on our radar, which we were liking better. So right now, I don't have any view on Yes Bank.
Okay, so which stock is a stock that you believe is a high return, high risk stock?
So at this point, a stock which we are considering in this space is Jindal Steel.
Okay.
So if you look at the business of Jindal Steel and the capacity, it has 10.9 million ton capacity of long products. Some 3 million ton of iron ore and some 6 million ton of coal capacity and around 9 million ton of pellet business. So if you look at the capacity, it is much ahead of what the production has been of late. So production in FY18 was around 5.69 million ton or something below 6 million ton. So they have had a good capacity ramp up, which is out for production now. So if we consider the cash flows and most of the capex plans are now over for the company, and we are expecting good volume growth going forward, and we have estimated around 15 to 23% top line bottom line growth for Jindal Steel. The risks are, there were payments of 3,000 crore in respect of coal blocks, and 1,700 out of that has been routed through P&L. So there is a risk of around 1,300 crore, which will be, the payment has already been done, but that can come into the books in the P&L extraordinary item, which will suppress the PAT figures on the face of it. And there has been a little bit, some 400 crore of royalty payment, out of which due, which is they have paid 130 around in that segment, and which also management is expecting that it's an undue charge, and they are expecting it to get back. So these are the two concerns, if we look at the extraordinary losses that can come into the books, though we expect that the cash has already been paid, so the cash flow would not be impacted, but then that's the risk that it's carrying. In terms of volume growth, there will be huge volume growth. They have, so the power business is a little bit under stress, but the steel business is doing well, and domestically there is good growth that we are expecting on the demand side also. So that's, we have outspoken target of 270 for Jindal Steel right now.
Okay, 270. So another 110 rupees upside or something. Is there any concern with, because one of the concerns while most of the steel stocks fell down was the declining spread, because prices across China have started coming off, and the raw material prices have started going up for be it iron or be it all the other raw materials. So is that a concern that you should have on the counter?
So overall that will impact the industry as such, because not specifically for Jindal Steel. So, and secondly, they have captive plants, captive 3,400 megawatt for power and coal and iron thing. And if we consider the volume growth, 10 million ton, 10.9 million ton capacity and 6 million ton already being done. So the volume growth here we are expecting to be much more, which would aid the margins. So it will not not the margins, I would say, it will aid the profit growth. So definitely that is one concern, but that's for the industry as such.
Okay, that's the view that's coming in. Mr. Chuknilam, any word on JSPL? Do you track it?
Yeah, I have tracked it. It's a good company, both JSPL and JSW. As you pointed out, there are only concerns on the industry because of rising deflationary pressure and trade war. China is not able to export. So a lot of surplus steel is available in the industry worldwide. But otherwise, they look good. And definitely for medium to long term, I would suggest yes.
Okay, and the last stock that we will talk about is to name a stock which offers a lot of potential in the insurance space. Of late, you've seen a lot of insurance companies get listed, be it on the life insurance side or the general insurance side. Which is the stock that looks good to them if our viewers had to select, because there's a ton of them. Which is the best one to select? Vineeta, which is the stock among the insurance space? Do you have coverage on them? And which is the stock that you are recommending?
So we are liking SBI Life Insurance amongst the insurance space. And last time also I had a chance to speak about it. So if we consider SBI Life, HDFC and ICICI Pru, all three together. So the kind of premium growth that is coming in SBI is around 42%, which is much ahead of ICICI HDFC. And the AUM growth is a little below, around 9%, and the market share is around 11%, and it's been gaining market share from LIC, which has been losing continuously. Q1 FY17 LIC was sitting at a market share of 55%. Now they are around 48%, and all these private players have taken away the market share. So HDFC Life, so there are two aspects to it. One is the valuation and the other is the growth. So if we look at the business of HDFC Life Insurance, so it is being offered at a higher valuation. The growth and management pedigree obviously is undoubted. And if we look at the ICICI Pru, so the valuations are a little low. It is around 1.8 times FY20 embedded value. Valuations are low, but then if you look at the AUM composition, some good amount is towards the equity, which makes a little volatile. So in that space, considering both these things, I think SBI Life, it is being offered around 2.2 times FY20 EV upon EBITDA. Considering the AUM growth, the premium, and whole industry, in fact, persistency ratios, solvency ratios have improved. But growth and valuation together mixed, I think we are liking SBI Life.
Okay, SBI Life. What about you, Mr. Chukuni?
Yeah, I agree with the analysis of SBI and ICICI Pru, but still I would prefer ICICI Pru because having invested in a lot of quality PSU related stocks and getting beaten, so I'm correcting my error because at least till general election, I thought I will not add anything related to PSU. I will just hold on, but I will not add because you don't know what government will do. So the perception also very bad in the market for PSU related stocks. So therefore, I would prefer ICICI Pru, which is down by 29%. As she said, it looks very attractive in terms of valuation also. Whether you take embedded value or book value, it is much cheaper than HDFC Standard Life.
Okay.
And also it is in the top 100 stocks. So there is a scope for a lot of mutual funds also focusing and accumulating the stock on further decline. So
on the fundamental side, what do you like about ICICI?
ICICI, longer period the growth much better compared to the PSUs, but it may not be as great as HDFC Life Insurance, but certainly it is better than the PSU space.
Okay, HDFC you wouldn't buy because of valuation?
Valuation, because if you look at the price to embedded value for the current year, HDFC is 2 times costlier than ICICI Pru, so therefore I prefer ICICI Pru.
Okay, so that's the view that's coming in on the insurance space. SBI Life as well as ICICI Pru Life Insurance are the two stocks that have been spoken about. But with that, we are completely timed out on this edition of Hot Money. Mr. Chokiningam, thank you so much. Vineeta, thank you so much for coming in to the studio. Ask BQ comes up next. Stay tuned to BloombergQuint.